Habit 5 to grow, control, and keep your hard-earned money. It's a dry one, folks, but we're going to show you how to reduce your biggest expense in life. You now know that you are your biggest asset. You are your biggest wealth creator. But do you know what your biggest expense in life is? It's not your house. It's not your vehicles. It's not even your children or your employees. Nope. It's taxes. Taxes will stop most from reaching or maintaining financial independence. Yet, even armed with this fact, discussions about taxes are still a very touchy subject, and it's not hard to understand why. We've been conditioned to fear the tax man. Our tax laws only seem to get more and more complicated, going from a 10-page document back in 1917 when it was introduced to Canada to over 3,227 pages and growing. Even one of my heroes, Albert Einstein, once said, "The hardest thing in the world to understand is taxes." Right once again, Einstein. When I returned to Nova Scotia in 2014, I was appalled by the amount of tax that came off each of my paychecks. Our property taxes were sky high with limited services, and the deed transfer tax was more like an FU tax or a welcome home sucker tax. I'm trying to keep this PG-13 here. The struggle with high taxes is real and significantly contributes to the high cost of living and doing business. It is my belief that if we had more access and control of our own hard-earned money, instead of giving it away to the government, we would be able to focus on what's truly important: our careers, our health, our relationships with our family and friends. This in turn will make our communities even better. That's why I am so passionate for helping people to reduce their taxes. But it's not right to tell people how to reduce their taxes. Everyone should pay their fair share. Tax the rich. These are comments I often hear, even from my own family. Let me ask you this question. Do you like how the government spends your money? If the answer is yes, you can skip this habit. If you share my frustration with high taxes and the mismanagement of those funds, let's continue. And let me be crystal clear. There's a huge difference between tax avoidance and tax evasion. Tax evasion is hiding income or making false claims, which is illegal. However, as a Canadian, it is your right to pay as little tax as legally possible. Tax evasion is illegal. Tax avoidance is just smart financial planning. If a flat tax was introduced where everyone paid their fair share, the need for most accountants, financial planners, tax lawyers, and even Revenue Canada would be eliminated. Until that day arrives, we're going to show you how to reduce your personal income and investment taxes, and let's discuss why this is important. Understanding the impact of excessive taxes. There are several unintended consequences that occur when taxes are increased beyond a reasonable limit. And I would say we're at that reasonable limit. Number one, there is financial strain. High taxes strain individual finances, leaving them with less money for daily expenses, personal goals, and financial security. There's crushed dreams. People feel trapped. It is crippling to small business. Lost opportunities for community development. High taxes can really stifle that community development initiatives and weakening supports for social causes. There's definitely a sense of injustice and frustration. We're seeing this. And then the emotional toll on mental well-being. Constant worrying and stress related to high taxes can take a huge toll on mental health. Understanding the emotional toll of excessive taxation is crucial. As you can see, raising taxes and excessive regulations are not the answer. Striving for a balanced and fair tax system is necessary to inspire financial well-being, empower dreams, and foster a sense of freedom for the doers and the dreamers, for business owners like us. With the current government spending, do you feel taxes are going to increase or decrease in the future? Tax Freedom Day here in Canada, the day that you stop working for the 3 levels of government and start working for you, was on May 27th in 1981 and June 19 in 2023. This is pre-carbon tax. When do you think Tax Freedom Day is going to be next year? If you want more information on this, to read more about Tax Freedom Day, go to the FraserInstitute.ca. Lots of good stuff on there. Hero to zero. In early 2008, I was the man, the monkey in charge of bananas. My office was on the 27th floor, overlooking my favorite pub, Kaylee's, and I had an expense account with my engineering job. Money just seemed to be rolling in. The natural gas was booming, and I could not go wrong with my stock picks. And when my stock options vested, I purchased even more stock after listening to my HR advisors and barstool advice. Then September 2008 happened. Shortly after, I lost my job and didn't get another one for 9 months. On top of this, I had a huge tax bill because of those stock options. Now, did I mention the proceeds I used from those stock options I used to buy more stock? Well, those stocks were pretty much worthless. I went from bar star hero to near zero almost overnight. Losing money sucks. Losing money and paying a lot of taxes on the money you lost sucks even more. It was a huge kick in the arse and a wake-up call. I made myself a vow to the moon and stars that I would never put myself or my loved ones in that financial situation again. I took my financial life seriously. I got proper financial education. I worked with professionals. This is when I discovered how much money I was leaving on the table, and that taxes are your biggest expense in life. I dove deep into the Canadian tax systems and laws. Feels like a big giant, but what I found out that while CRA aren't necessarily out there to help you, they have humans working for them, and they're not as scary and mean as the media makes them out to be, especially around tax time. When doing my taxes, I looked at every single line. And if I didn't understand what it was lined for, I called CRA until I got the same answer twice. And of course, this often took more than just 2 phone calls. Hey, I was unemployed at the time and I had lots of time to do this. And I discovered 2 very important lines that will help you and every Canadian substantially reduce their taxes personally and investment-wise. So let's leg drop those taxes in the neck, shall we? Line 135. There is no better way to create tax deductions than owning a small business, and in most cases, running it from your home. Think about it. In 1919, what did most people do for a living? They're farmers, fishermen, mercenaries, bankers. They were generally business owners. The tax system was set up for business owners. And then there's line 221, where you borrow money to invest, and also you could use the Smith Manoeuvre. The Canadian government introduced a foolish tax deduction during the original Trudeau era to compensate for the fact that our neighbors to the south were able to claim the interest from their mortgages on their personal taxes. Now, that didn't happen. They changed the ruling around a little bit to say if you borrow money to invest in an investment that earns income such as interest or dividends outside of your tax-free savings account or RRSP, you can deduct the interest from that loan that you paid. Note, if you're borrowing any money for a legitimate business purpose, the interest is also tax deductible. This would be included in business expenses on line 135. Is your primary mortgage tax deductible? Not in Canada, unless you convert your mortgage debt into investment debt. This is commonly known, or not so commonly known, as the Smith Maneuver. The Smith Maneuver is a strategy that converts non-taxable debt simply to taxable debt, almost just switching pockets from pocket A to pocket B. Any loan, such as vehicle loans, on which interest expense is not deductible, can and should be converted into deductible interest, aka a mini Smith Maneuver. This is how the Smith Maneuver works. You get yourself a home line equity credit, commonly known as a HELOC. This is secured against the equity in your home. You then borrow the money from your HELOC and put it in investment generating incomes or investments such as dividend paying stocks, mutual funds, ETFs, or investment properties. The interest now becomes tax deductible. The money grows with your investment. You can either pay it back or continue to have that money grow and compound over time. It's important to note that the Smith Maneuver requires some careful planning and execution. And obviously, the Smith Maneuver is not suitable for everyone, and its success depends on several markets such as market performance, interest rates, and your risk tolerance. If you're interested in exploring this strategy further, I recommend seeking professional advice from independent financial experts that can help you make informed decisions. You can also find more information at www.smithmaneuver.com. All right, so we talked about business deductions from line 135. You are a business owner and listening to this, you're a consultant. The question that comes around quite often is, should I incorporate? I would say generally the answer is very similar to, does a one-legged duck swim in a circle? The answer is only no if you're not making any money. If you have liability concerns regarding your business and assets, meaning you could be sued or creditors could come after your assets, and if you keep any of your income from your business, you need to incorporate. Unlike a sole proprietorship or partnership structure, a corporation is its own legal entity, which protects the owner from liability. It also carries the advantage of lower tax rates, access to the capital gains exemption, and makes it easier to apply and raise capital. However, I guess there are some negatives. There can be higher administrative costs due to setup fees. There is more paperwork, and you need to enlist the help of professionals to handle this more complex tax filing requirements. Here's a quick list of some of the positives and drawbacks from incorporating. Some of the positives: reduces liability. Your income tax is deferred or saved. You can transfer the business, no problem. Control of your own personal income. There's more opportunities to raise capital. Your business name is protected. There's the lifetime capital gains, income splitting in certain circumstances. There's an unlimited lifespan of the business, meaning it can continue after you pass on. And incorporation just seems to boost your business reputation as well. Okay, some of the negatives. It says here expensive setup costs. Is really not that expensive if you do it right. Additional tax returns, so a little bit more work. Increased paperwork. And the incorporating tax can be daunting and frustrating. You definitely need an accountant to do this. I try to do it myself. I'll talk about that soon. Do not do it yourself. And closing your business, you got to take some precautions into that as well. So when your income reaches $250,000, your personal income tax rate might average only 33% federally. When I say only, I mean just federally. It could be over 50% when provincial income tax is included. In contrast, when you incorporate, the small businesses would be taxed from 9 to 15%. You can see the huge, significant tax savings right there. So the real question is not should I incorporate, but how do I incorporate properly? How do I grow, control, and protect what I build instead of giving my hard-earned money away to taxes, fees, losses, and the unknown? How to incorporate properly. One of the traits of most engineers is that we like to do things ourselves. When I incorporated my consulting business, I tried to save money by doing it myself. When I attempted to do my own corporated taxes, this is when I threw in the towel and finally went to an accountant. They fixed all my mistakes and helped me incorporate correctly and efficiently. Do yourself a favor and contact a professional accountant and lawyer that will help you incorporate correctly the first time. This will save you time, money, and frustration. The first year should cost approximately $1,500, okay? So not that expensive. If you need help picking an expert that you can trust, read Habit 6, where you can find the right accountant and lawyer for you. Incorporating the business obviously can be done federally or provincially. There are generally 4 basic steps when you incorporate. Step 1 is name the corporation. Step 2, prepare the files and articles for incorporation. Step 3 is establish the initial registered office address and board of directors. And step 4, submit the application and pay your fees. This is described in detail in the books, and you can find lots of information on there here. No need to put you to sleep by listing every single step. As a business owner with a corporate structure, you can pay yourself with a salary or in dividends. It is usually recommended to do a mixture of both. Due to the crazy personal income taxes we pay, it is wise to keep as much money inside your corporation as possible where it is protected and will grow tax efficiently. Incorporated businesses can make money from things that they actively sell. This is known as active income, or from their investments, known as passive income. Canadian-controlled private corporations can use the provincial small business tax deduction. This allows them to pay a lower federal tax rate on the first $500,000 on active business income. However, businesses earning over $50,000 in passive income may lose some of the access to the small business tax rate. A holding company and additional operating or real estate corporations may be necessary to retain this deduction. From my experience, you should have a holding company if you answer yes to the following. Can my business be sued? Can I afford to live off less money than my business is generating? And can I sell my operating company in the future? The positives of having a holdco, this is slang for a holding company, is potential, even further potential reduced liability, potential for tax deferral and savings, unlimited lifespan of the business, as I mentioned, potential access to the capital gains exemption. You can put a properly structured dividend paying whole life policy in it, and investments and savings are not connected to the operating companies. Okay. The negatives of a holdco, again, increased bookkeeping, increased legal and accounting costs, and extra regulatory paperwork. Here's how most businesses operate. They work hard only to pay personal high income tax, even though they pay themselves a mixture of dividends and a salary. Hey, a lot of money is needed to cover those high costs of living, especially if you want to live in a nice home, have nice vehicles, and want to make sure you are protected and invested for the future. Unfortunately, the only financial advice most receive is from their accountant that tells them to invest in RRSPs to reduce their personal income. Their money sitting inside their incorporation is either doing nothing or invested in high risk investments that could lose access to that small business tax rate if they make more than $50,000 in passive income. Talk about the vicious cycle of money. There is a better way. Do this instead. Work with your lawyer and accountant to set up a trust in a holding company. Additional operating and real estate companies may also be needed. Maximize your expenses within your operating company, such as your health and dental benefits and vehicle and operating costs. These are tax deductible. Inside your holding company, diversify your investments, including high interest savings account and a properly structured dividend paying whole life policy. The best tax shelter. After reading about the perfect investment in Habit 4, you now know that a properly designed dividend paying whole life policy is an excellent thing to have in the case of your death and It will provide a way to grow and use your money tax-free. The and asset or tax-exempt insurance is also the best tax shelter to have inside your corporation, preferably in your holding company. Traditional investments like stocks and mutual funds may not be the best choice due to the risk and tax implications within the corporation. And listen, you are already putting your money at risk by running your business. These investments, the mutual funds and the stocks, are taxed heavily inside a corporation and could trigger a loss of your small business credit once you make more than $50,000 a year. The growth on your properly designed whole life policy grows tax-free and is not recorded as passive income. You don't have to worry about losing that small business credit, even when your policy grows leaps and bounds due to compound growth. Now look, grow, control, and keep what you build. Don't give it away to taxes, fees, or losses. So what's the point? Financial planning is easy until you add emotion and taxes. Until a flat tax is introduced, work with a team of independent experts that have your best interests in mind. Habit 6 will help you find an expert that you can trust. As a Canadian, it is your right to pay no more or no less tax than what is required by law. Taxes are your biggest expense in life and a major villain towards you reaching and maintaining financial independence. There are simple and legal ways to drastically reduce your income and investment tax that will help you optimize your financial future and still buy the stuff that you want. Tax evasion is illegal. Tax avoidance is just smart financial planning.